Hi, everyone. My name is Randy Bruns. I'm with Model Wealth. This table that we are looking at is 99 years of returns for cash, bonds, stocks, and various allocations of bonds and stocks. And it's from 1926 through 2024. We're going to quickly walk through how you interpret this data, but also how it applies to our financial planning efforts here at Model Wealth. If you are a client, you will have recognized this in some of our videos or meetings or financial planning summaries. If you're new to Model Wealth, it'll help you understand how we view markets and risk and return. So without further ado, let's move me over here. So what we're going to do is we're going to just look at the data here. You'll see 100% cash down here. You'll see 100% bonds, 100% stocks, and then from the bonds to the stocks in 10% increments, 10% stock, 90% bonds, 20% stock, 80% bonds, all the way to 100% stocks. And then you'll see here the average annual return on paper, but inflation erodes purchasing power of any investment. So in the third column, you'll see the inflation adjusted average annual returns. Some folks refer to those as the real returns. And before we get into the data, let's just look at the measuring sticks that represent the returns here. So for 100% cash, you can see that that is basically the Citigroup 3-month Treasury bill index for the bond market, which is it's basically loans. You're a lender, you're a bank if you own bonds. That is most recently represented by the Bloomberg US Aggregate Float Adjusted Index. And if we look at the stock market, this is just US stocks, but you'll see here the CRSP, which stands for the Center for Research and Security Prices, US total market. So here's basically how you would read this. If you look at cash over the last 99 years, you'd have gotten about a 3.34% average annual return. If you said, okay, well, I don't want to be a depositor at the bank, for example, I want to be the bank. Well, that's the bond market. You'd have gotten about a 5.04% average annual return. And if you said, well, I don't want to do nothing and just be a depositor, I don't want to be a lender, I want to own businesses, I want to be a stockholder, a shareholder in the United States stock market, over the last 99 years, you'd have gotten a 10.47% average annual return. That includes the Great Depression, it includes the Great Recession, it includes all sorts of negative periods, but it also includes the bull markets. So 3, 5, and 10% averages over the last 99 years for being a cash, bond, or stock investor. But inflation erodes some of the purchasing power. So if you look at the inflation adjusted average annual return, it's been about a 0, a +2, and a +7 to be in cash, bonds, and stocks. The +7, that is over a 99-year period. There have been 20-year periods throughout the stock market's history where you only got a +1% inflation adjusted average annual return. So that does seem easy on paper if you were an emotionless robot, but 20 years is a very long time. And then on top of that, there's a lot of just violent markets in getting to that 7% real rate of return. So if we look at the 1970s, you'd have lost 37% from 1973 to the end of 1974. In the tech collapse, started in March 31st, 2000 to September 30th, 2002, you'd have lost about 44%. And in the Great Recession, starting basically December 31st, 2007 to the end of March 31st, 2009, you'd have lost about 44%. Now, the official bottom of that market was March 9th, 2009. And so markets were down a lot more than negative 44%. This is through the end of March. This is through the end of the month, basically. The cost, if you say, well, I don't want that volatility. Well, the cost of daily certainty, daily availability, if you just left your money on the sidelines, is basically a return that at best follows inflation. So what we will do here is let's just put a calculator up on the screen, and we'll just start with we'll just use a sample $100,000 investment. If you put that money in a savings account or a money market or short-term CDs, you would say, okay, well, let's see what it grows on paper. We would multiply times 1.0334, and that would give you the same amount plus an extra 3.34%. And let's just do this over a 20-year period, for example. Not that these are guaranteed returns over the next 20 years, but hypothetically, let's just apply the last 99 years to the next 20 years. You would just multiply that 100,000 times 1.0334, and I could hit enter. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So there is 100,000 growing to $192,916 over a 20-year period. And you'll say 20 years later, what does 192,916 even buy me? So an easy way to figure this out, to know what it would buy you, is just to use the third column, the inflation adjusted average annual return, and 100,000 times 1.0039. So now we're going to hit enter 20 times, because now we're going to be able to see what the actual purchasing power would be in today's dollars, but 20 years from now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So there, your 100,000 is basically growing to a little over $108,000. Now, taxes will erode some of that, but also it's important to know that this is the last 99 years. There have been 20-year periods where leaving your money on the sidelines in cash has lost value to inflation. So in other words, your $100,000 20 years later could have been worth today's feel of $95,000, for example. That is the cost of daily certainty, daily availability. When in planning, we like to use a 0 or maybe even a negative 1% average annual return. So if ultimately what you could say is $100,000 at best is what we would say 20 years from now, it'll still be worth what today feels like $100,000. If we take that same 100,000 and instead we say, let's multiply times 1.0204, which would simulate the historical inflation adjusted average annual returns of the bond market. Again, these are not guaranteed by any means, but we're just applying historical returns to the next 20 years just to give you some ideas. So times 1.0204. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So here is a $100,000 investment growing to today's feel of just under $150,000 over the next 20 years. So there is some real return. And that makes sense, because if leaving your money on the sidelines in cash paid the same returns as lending it out in the bond market, nobody would make loans in the bond market. So there has to be a premium to take on that risk of being a lender versus parking your money on the sidelines in cash. And that's why these are called risk premiums as you step out of cash and become a lender. Or in a second, we're going to show if you step away from being a lender and want to own businesses. So we've got 100,000 growing to 108 in cash over a hypothetical 20-year period, 100,000 growing to about 150,000. And now let's take that same 100,000 and we're going to assume over the next 20 years, you get the historical inflation adjusted average annual returns of the stock market. But again, be very careful with these. We would never use a 7% inflation adjusted average annual return in planning. We definitely undershoot these. But let's just put the 7.31. So times 1.0731, and we're going to hit enter 20 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So that's the power of investing in stocks over long periods of time. Your 100,000 grows to today's feel of over 410,000. So ultimately, if for the safety and certainty and daily access of keeping your money on the sidelines in cash, your 100,000 grows to today's feel of 108,000 by historical returns. If you loan it out in the bond market, your 100,000 over a 20-year period grows to today's feel of a little over $149,000. And if you own businesses and you get the historical returns of the stock market, which again, you should not expect history to repeat itself in planning, but if it did over a 20-year period, your $100,000 investment would grow to today's feel of $410,018. Now, when you put these returns into a planning context, the more your dollars grow in purchasing power, if you're saving for retirement or saving towards a future goal like college, the less dollars, the more return your investments earn, the less contributions that you have to make out of pocket, and the easier it is to save towards a goal. But the thing you have to understand is with each, as you climb up, if you get out of cash and you become a bond investor, you're starting to get more volatility. So roughly 1 out of every 5 calendar years, you lose value. It does not mean your portfolio necessarily loses value over time, but there is volatility. And as you start adding stocks to an otherwise all bond allocation, your average annual returns start to rise. The inflation adjusted average annual returns start to rise, but eventually if you get to a 90% stock or 100% stock, you're now starting to lose value about 1 out of every 4 calendar years. That's the cost of beating inflation over the long haul, and the cost of having the certainty and safety and availability is at best maybe following inflation. So these are all, this is how we think about investment returns and risk in the context of planning. If you have any questions, feel free to reach out, but we hope you enjoyed this video. Thanks.